But the idea of being anti-fragile means you actually get stronger under pressure. You're not just durable like Teflon or a good Teflon piece. It's actually something that becomes stronger under pressure. Our chairs, our smartphones, they're a bit durable. Some of them may be even fragile, but the things that are actually stronger under pressure would be something like your body. I want something like my human body, which actually gets destroyed in a workout, ripped apart, but then builds back better and builds back stronger. So to me, resilience is building back stronger, and under immense amount of pressure up to a point, our bodies, our minds, our hearts, even our finances can do that if we set it up properly.
I love it, and I totally agree. And diamonds are made under pressure. I always say it's one of my favorite sayings. I don't remember who said it, but I love it. So give us a quick down and dirty about where you come from, where did you grow up, and how did this whole personal finance thing start?
Yeah, thank you. Well, I've had the great privilege over the years now, over the last decade, of working with business owners, real estate investors, veterans, and really, even NFL Super Bowl champions. But most of the people I work with are just wanting some more certainty, control, agency in their life. And they have found over the last, many years that I've been working with them that as they come to me, they're saying things like, Mark, I can't believe it. I just lost a third of my life savings in the stock market, or I'm up to my neck in debt and I don't know how to get out. So part of our process that we work on with clients all around the country is how do we build sustainable and practical solutions that help them overcome these problems. Now, I didn't grow up with any of this. I didn't grow up with a lot of money, and I didn't understand much about the financial world as a kid anyway. In fact, I graduated from college with just a mountain of student loan debt, and it was in the midst of the Great Recession, and it was hard to find work, and I didn't know that it was a problem. That was the worst part, Richard. It wasn't the debt, it wasn't the unemployment, it was the ignorance that it was a big problem. That I didn't have a plan was the biggest problem of all. And so, fast forward, finding strategies and getting passionate about, it's funny how the 30-day bill cycle will get you focused on money because you scratch together this month's giant payment to Sally Mae and all of her bankster cronies, and you're feeling so good about it, and then all of a sudden, wash, rinse, repeat, you're back in their pocket again. Every 30 days you got to scratch together a giant payment to pay off the banksters one more month. And so it's amazing how that regular monthly cycle will get you focused on your money. And that's exactly why my wife and I finally got focused on our own finances. We were tired of the debt and we wanted something better. And we didn't just want, a typical life. We wanted a not so average life, not just in money, but in all areas of life. So that's what's got us stumbled into different financial strategies that have not only helped my wife and I get financially free and but also our clients as well. And that's what been my privilege now for the last 11 years.
All right. So let me ask, because, as we talked about earlier before we came on, and then you said, working with an NFL veteran. An NFL veteran's lifespan in the NFL is 2.5 years. And the average veteran usually goes in for 4 or 6. And when we get out, we're like, okay, now what? We don't have the savings that we have because, we think we're going to be wearing that uniform forever. It's never going to end. The money's never going to stop. And then all of a sudden, like you said, I've had several NFL players, Hall of Famers come on, and they're like, most of the guys that they played with are bankrupt within 3 years. And I think it's because they didn't really take their finances personally. Like for me, I almost went bankrupt. Thank God I didn't. And the only reason why I didn't, because I went through Dave Ramsey's Financial Peace University. Some people like him, some people don't. For me, it helped me, get my finances in order. But, so talk to us a little bit about why financing is so personal. And a lot of people don't want to talk about money. For me, growing up, my parents argued about money, but they never taught me about money, how to balance a checking account, how to build your credit. until I bounced a check and went to jail for bouncing a check. So talk to us about why there's such a stigma about personal finance, not about money, about to get rich, but about the personal side of finance.
Well, it's certainly true that personal finance is first and foremost personal. And there's a lot of emotion tied around money. And usually it goes deep into your subconscious, to be quite candid with you. It's why 70% of lottery winners go bankrupt, um, in part because they don't have the belief structure that supports their current reality. Their reality is something different than what they believe. And that's okay. I have the same problems with, I would want a washboard abs, but I also love potato chips and ice cream. I mean, we all act against our beliefs all the time, and our beliefs sometimes will misinform our reality, and our actions are usually played out of our beliefs, whether we realize it or not. So I know that's a little bit of a deeper answer than you may have wanted, but the honest truth is it starts with us. It's personal finance, of course. So yes, there's been a lot of tissue boxes that have been used in my office over the years, because tears are usually shed at certain points. We don't aim for that. That's not our goal, but sometimes it's the first real conversation a couple has had about money, even if they've been married for 10, 20, 30 years, that they've somehow made it through life without ever really talking about their finances. And so, yeah, I think the best thing we can all do is really decide what's working, what's not working, what are we going to keep? What are we going to improve? What can we start and what can we stop? It's a great after action review with how your money has, interacted with you thus far in your life. Doesn't have to be anything profound. You don't need a bunch of tears or tissue boxes necessarily. You just need to think through what's working right now and be honest about it and say, all right, what is actually helping me toward my goals of whatever I want to be in my life? What's not working? What do I need to cut out? Keep, improve, start, stop. That's the KISS method, right? Keep, improve, start, stop. So just try doing that after action review with money. Up till this point, how has money served you and how are you serving your money?
And, me and my wife, we've known each other for over 40 years. She controls all the finances because that's what she's great at.
Mm-hmm.
I don't have any clue how much I got in the bank. When I go to Guitar Center, I just say, honey, can I buy something? But I know that was my weakness. That's her strength. So I let her roll with it. But if there's any arguments, we don't have any arguments except for money. And of course, it's a lot of my stupidity anyway. But now we know the Christmas season. Everybody loves giving Christmas gifts. Everybody loves this. And then January 25th, the bills become due. And that's when the stress really begins. So talk to us a little bit about that. Everybody wants to see the car commercials, but they don't see that car payment 30 days from that point on, or the Zales jewelry. They don't see the payments that are coming up. So talk about that, because I love the KISS principle, the keep it simple, stupid principle. Yep. So talk about that and finances, especially over these holidays.
Yeah, that's true. I think Gloria Steinem said it best. Rich people plan for 4 generations and poor people plan for Saturday night. And that's a mindset as much as anything else, because we all look for Christmas and we want to have a great experience with our family and be as generous as we can. And that's a good thing. And we often forget two other dates. One is 30 days later. That's, we might call that Grinchmas, 30 days after Christmas when the bills come due. And then I would also say next Christmas is the other day we often forget, because it's funny how Christmas seems to sort of show up once a year. And so we're thinking about 30 days from now, or as we're recording this, it's middle December or so. So we're thinking 20 days or so from now, it'll be Christmas Day. But what we're not thinking about is a year and 20 days from now, it's going to be Christmas again. So what can we be doing right now to prepare for that next eventuality? The anniversaries of life, the happy birthdays of life, the tax day, the things that typically are the regular but infrequent expenses that come to us and just sort of throw our regular spending plan out of whack. It's funny how these regular property tax bills and kids' tuition or whatever it is comes in a regular way. if we could find a way to kind of piece that out and allocate it throughout the year, doesn't have to be, any kind of like rigid budget, but it could be something that, hey, you got a little pocket of money this month, put it in your future Christmas bucket or whatever it might be. It's simple rules like that. We really try to follow 4 rules when it comes to budgeting. And then we can talk about the becoming your own bank, because I know that was part of what you wanted to talk about. But the 4 rules that we follow came from a group called YNAB, You Need a Budget. And the 4 rules are, in principle, this. Number 1, give every dollar a job. Don't leave a single dollar unemployed or they're going to go work for somebody else. So that's rule number 1. Rule number 2 is embrace your true expenses. You got to embrace everything, including next year's Christmas, including your property tax bill, the dentist bill, the braces, the things that don't come every week or every month. Rule number 3 is roll with the punches. So when something happens in your month that is outside of what you expected, you got to be able and willing, and your budget has to be dynamic enough to change when you need to. You got to get off the spot. You got to be able to say, all right, we spent way too much at the restaurant last night, so we're going to have to dial it back on how much we spend at the, at the weekend, at the bar this weekend or whatever, or maybe spend a little less on clothing. So you just take from one category and adjust it to the other. That's rolling with the punches. And then finally, the last rule is age your money. And this just means to try to let that money sit and season in your checking account for more than 15 seconds. I was working at a restaurant when I was just out of college, just trying to pay the bills, get out of my debt problem that I had found myself in. And I noticed that some of the people working there, mostly the family guys and gals, the people with kids, they would keep that money that they earned in tips, put it in a little envelope. And then they'd stack that money, stash it all month long, and then they'd spend it the following month. Whereas the other crew were just maybe the party goers. They would earn their tips, earn their money for the night, and then they'd go to the clubs later that night and blow everything that they had earned earlier in the evening. And so they were dependent on that cycle. And if they didn't make tips, they didn't get to go to the club. That was the whole point. So aging your money means you keep that money in your checking account or in your envelope for more than 15 seconds. Could you possibly live on last month's income? Whatever you made last month, let's allocate that money to this month. And again, give every dollar a job. So those are the 4 rules of budgeting. Any insights or comments, feedback on that?
No, I'm actually loving it, because I remember growing up, my mother had envelopes, cash envelopes. That's when we actually used cash.
Right.
Then she would go to the bank, cash her check, and then she would do the envelope system. And if there was nothing in the envelope, whatever that envelope was, we weren't doing. So I think that's great. But first, I want to thank our sponsors. I want to thank them real quick. Without them, we wouldn't be able to do what we do. But for me, I also realize the more that I give, the more that the world, God, I consider God, gives back. And so if you want to help me help veterans struggling with PTSD and homeless, pick up one of our t-shirts, one of our coffee cups, some of our brand new coffee that we came out with, Vertical Momentum Coffee. 100%, and I'm saying 100% of the profits go to help veterans struggling with homelessness and PTSD. So if you love coffee with a mission, let me know and I'll get that to you. Also, if you're a veteran and want to start your own business, Operation Veteran Freedom is a company. They're a nonprofit that they actually help veterans start their own companies and start getting out of the rat race, like Robert Kiyosaki talked about when he was on the show. Okay, so now let me ask you a question, because I want to dig deep into this. Everybody says they hate banks, and I totally agree, but nobody wants to save anymore and become their own bank. For me, I'd rather have the money in the bank and loan it to myself and pay myself back than give it to a bank and have to pay interest on it. So talk about the principle and how do we become our own bank?
Man, yeah. Well, the principle, and then there's the how. So first, let's talk about the principle, then we can get into the how. What do you say?
Let's do it.
The principle is this. Hey, banking is one of the oldest financial industries in the world. Let's just say that. It might be maybe tied for the oldest profession in the world. Let's say it that way. There's a great book out there called Debt, the First 5,000 Years, Richard. 5,000 years of banking, of debt. Imagine how many lives have been ruined with that four-letter word of debt. And banks, as you know, are some of the biggest, most profitable businesses in the world. And, the average American is saving, as of this month, only 2.3% of their income. But the average American, according to the U.S. Commerce Bureau, is in debt and servicing that debt almost a third of their income. 27% of their income goes to service debts. Can you imagine that? That means a third of your day. If time is money, Richard, that means a third of your day, you're just a slave to the bank. And if you're better than the average, that means somebody else is twice as bad. So, this is a major problem for much of America. So this can include your mortgage. This can include student loans, car loans. And many people will say to Mark, I'm not that bad. I've got low interest on all my debts. And I've got a zero interest credit card. I've got low interest on my mortgage. Thank goodness. I've got, a low interest student loan. And I'll, first of all, congratulate them on all that. But then we'll look at the volume of interest that they're paying. So it's not so much the rate, it's the volume that kills you. It's not so much the rate at which I eat food, it's the volume that's going to impact my waistline. It's not just the rate of your debt, it's the volume that will kill you. And if you're spending 30% of your income on your debts, that's a giant volume of your income just getting funneled into a banker's pocket. Banks are the ones that control the environment in which your money lives. When you finance a car, who's the one in control of that process? You or the bank? The bank's in control. Yeah. They get to control what? They get to control the terms, the monthly repayment. They get to control the interest rates. What happens if you don't keep up with your payments? What do they do to that car? Well, they come repo the car, right? They wreck your credit score. It's a humiliating experience to see that thing get towed away. And then it makes it very hard to get the next car, right? Most people live on the debt staircase, where you are clawing and climbing and scratching your way back to the top, the level line where you're back at net zero and you finally paid off your debt, and you can call Mr. Dave Ramsey and scream, I'm debt free. Yeah. and he's famous for that, and good for him. And I too have had a lot of things to say thank you to Dave for getting us focused on our finances. But he would always tell you to just save up and pay cash for cars. Let's think about what happens there. Where does your money get saved typically? Well, it's typically going into a savings account at where? A bank. Okay, so first let's stop and think about the irony there. So let's say, Richard, that you've put $10,000 of your own hard-earned money into a savings account. Good for you. How much interest are you getting for that savings right now? Nothing. Yeah, nothing. And what do they do with the money? Do they just leave it in their vault with your name on it?
No, they service it out. So that's right. And get interest on it.
That's right. They're loaning it out to the guy behind you in line asking for a loan. And how much do they charge that guy behind you asking for the loan? The guy behind you in line asking for that loan. How much do they charge him? Is it 0%? No, it's
anywhere from 15 to 30%.
Yeah, it could be 15, could be 30%. Good night. Now, how much of the bank's money did they have in that transaction? Zero. Man. So we call that an infinite rate of return. Infinite rate of return. That's unbelievable. So first of all, for those people who didn't know that, look up fractional reserve banking. That's what that's all about. Second of all, how do we do that? And how do we do it legally as mere mortals, not mega corporate bankers? How do we do that? The problem with paying cash is, one, you're participating in that system and making it worse because you're saving in their bank. Two, what happens when you spend money? If I need to buy a car and I pay cash for that car, what happens when I withdraw money out of that bank account? Even the pennies of interest that the bankers were so generously giving us to save our money in their bank, how much interest do you earn on money, Richard, after you withdraw it? How much interest do you earn on money after you withdraw it?
Not a penny.
Yeah, correct. Totally right. Yeah, $0. You've broken the growth trajectory of that money. So let's say the car was going to be a $30,000 car. And let's say you found a magical savings account that was going to pay you 3% or something, or 5%, or even just 1%. Who cares, right? It was going to pay you something to keep that money saved. Maybe you withdrew that money, paid cash for the car, and you hear Dave Ramsey, cheering you on. He's patting you on the back as you're driving that vehicle off the lot. But now what happened? You've now broken compound growth on that money for the rest of your life. The price of the car was $30,000. But the real price or cost of that car, might be $100,000, $150,000, depends on your age. But the compound growth has now been broken for the rest of your life. This is the problem of paying cash. You're financing it. You're still financing everything you buy, even when you pay cash. This is something Dave didn't tell me on his radio show. You still finance everything you buy when you pay cash for things. You're passing up interest you could have earned on that money. You're financing it from your future self. You're taking money out of the hands of future Richard or future Mark. And you're saying, I'd rather my car today. Thank you very much. So I didn't like that. And I certainly didn't want to do that with my student loans because I was in a terrible spot. I had this massive debt and I didn't want to just throw my best money away into a hole called Sally Mae and all of her bank cronies and everybody else. So I had to find a better way to one, pay off my debt, and two, buy my cars and all the other things I wanted to buy in my life. So this is where I had to find a way to be better than a debtor, and I wanted to be better than a saver. I wanted instead to be a wealth creator. And the process that now we kind of had to find was, how do we do what banks do? If banks are telling me to put money in their bank savings account, and they're telling me to put money in their CDs and money market accounts, I wanted to know, are banks actually doing that? Are banks following their own advice? And the answer is no. So where do they keep their money? Well, funny enough, of all things, there's a tier 1 public disclosure. It shows you exactly where banks keep their money. And I didn't want to do what banks told me to do. I wanted to watch what they did, and I wanted to go do that instead. So I looked into the tier 1 capital ratios of the major mega banks and even the credit unions in this country. And the biggest piece of their tier 1 capital, that's the safest place that banks keep their cash, is in life insurance, of all things. Cash value, dividend paying whole life insurance. And it's called bank-owned life insurance. You can look this up on Google. Just type in BOLI, B-O-L-I, bank-owned life insurance. These banks have hundreds of billions of dollars tied up in cash value life insurance policies. Bank of America in particular, just picking them at random, they have more cash value in their life insurance policies than all of their real estate valuations combined. Now, this shocked me when I saw this. So why the heck are they putting money in cash value life insurance? Well, it's because you can use it like a bank. That's right. It's sort of like becoming your own bank. So before I dive into that, Richard, let me pull my car over, man. What insights, feedback, comments do you have so far?
Well, I'm 53 years old, and so when I was a youngin', back in about 18 or 19, I got invited to go sit and listen to somebody talk about how to buy term, invest the difference with a company called A.L. Williams back in the day before they were Travelers, Primerica, and all that good stuff. And I thought, well, it made sense the way I hear it. And I've never heard anybody since then talk about what you're talking about right now. So you really piqued my interest, and my ears are like, bing. Because I'm like, wait a minute, even AL and even, all these financial talking about buy term and investing the difference.
Yep.
They're all bullshitting me.
Well, hey, I think they're probably coming from a good place. I got to assume angelic intentions, but man, I'll tell you this, my anecdotal research, having talked to now thousands of families across this country who listened to that advice, here's what they ended up doing. They bought term and then they went out to eat. Right? They didn't invest the rest. They didn't ever. What is the rest? The rest is whatever your whole life premium would have been. You go put that into the stock market. And by the way, those that really did invest, how did they do? Here's third-party research Go look this up. It's by Dalbar. Dalbar's just up the street there in Massachusetts. So look them up. They've got an annual report called the Quantitative Analysis of Investor Behavior Study, and they look at real investors over a long period of time. We're talking 30 years. So after a 30-year time horizon, how did you do in the market? Not the stock market, not an index, but how did Joe and Jane investor do in their portfolio? You ready for the answer? Remember, this is the last 30 years. This would be like your 1990s up through today. And we're talking some big money made in those 30 years, right? So, I mean, the baby boomers were coming of age. There was some big bull markets. There were some crashes too. But overall, it was a pretty phenomenal last 30 years. How did we do? Well, according to Dalbar, if you were all in, 100% in stocks, equities, 3.6% per year over 30 years. Now, is that going to solve our problems? Is that going to get us through retirement to get 3.6%? That's before taxes, by the way.
And it's that's before inflation.
Right. Yeah.
So you're pretty much made zip, zilch, nada.
Come on. Yeah. Preach it, man. That's right. I was floored as a certified financial planner. I didn't see that as acceptable, but so I never really, I never had that A.L. Williams moment, but I was a believer in Dave Ramsey's whole thing. And he was a big, buy term, invest the rest guy. And he hated, like with a passion and a disgust, whole life insurance. And I wanted to know why. Part of it was one of his sponsors is a term insurance company, I found out. But two, I think he's got a big, a push into, a certain frame of mind. And in fact, when I first heard about whole life insurance as a place to park my cash and to build real wealth, quite candidly, man, my mind shut off. My ears weren't just pinging. My mind was like, I was going dark. My eyebrows got furrowed and I kind of crossed my arms and I was like, no way. And the professor friend of mine who was sharing this strategy, we call it bank on yourself, he was sharing this with me, and I quite honestly thought he was in some sort of a scam or something. I needed to find a way to help him get free. So, but the more I looked into it, the more I could not look away. Here's why. For those that are still listening and still have an open mind, thank you for listening, because there's enough on the other side of this. If you can kind of get through this idea of life insurance, that I think you'll be pleasantly surprised. And back to why and how we can be our own bank. So, one, this is a cash value whole life policy. We're not just renting the insurance, we own it. So when you rent an apartment, the cost gets more expensive. The landlord can raise the rent on you as you age. When you rent an apartment, you don't build any equity in your apartment, and you don't build any equity with term insurance either. And with term insurance, the landlord, the insurance company, can kick you out at the end of the term. They can refuse you to get more insurance. With whole life insurance, the costs do not go up every year. The cash is building. There's a wealth or an equity that's built up, kind of like when you own your home. And the value of that asset is going up on a guaranteed basis every single year.
All right. So now this for me, I break everything down Barney style, and for me, my first thought would be, well, don't I have to die in order to enjoy it? If it's life insurance, I'm sure you get that a lot, right?
Yeah, that's right. Yeah, with whole life insurance, no, you don't. With term insurance, yeah, you got to die to win with term insurance, but this is not that. With dividend paying whole life insurance, there's a cash value that's building up even in the first few months. All right. So, you could dump some money into a whole life insurance policy, and then you can access that equity. Kind of like when you own your home, you have equity in your home, right? You don't have to sell your home to get access to that equity. You can do a number of things to get access to that equity without selling your house. And it's just like that with whole life insurance. There's something called a cash value, not just a death benefit, but there's a living benefit, and they call that a cash value. And that cash value, Richard, is the best part for me, especially on this side of heaven, right? I know my family will be happy with the death benefit someday, but it's the cash value that really gets my attention. So what does the cash value do? And I'll try to do this in a minute or two. Try to keep it brief. Whole life insurance cash value grows guaranteed every single year. contractually guaranteed by the insurance company. Even this year, when the markets have been going nuts, crashing and dropping and going nuts in volatility, my policies, my clients' policies have been hitting all-time record highs this year again. And they'll do it again next year too. It's guaranteed. And they'll throw dividends on top of that guarantee as long as the insurance company is profitable, which they've always paid a dividend over the last 100 years. So I love that. That consistent growth is pretty phenomenal. Second, that cash value is liquid, meaning I can access it, meaning I don't have to wait till I'm dead. And unlike a 401k, I don't have to wait until I'm 59 and a half to get my money out. I can get it out when I'm whatever age, and I can get it out for any reason. And I can get it out without any taxes due. If I've designed it correctly, it would be tax-free for me, both when I'm 39 and a half or 59 and a half or 89 and a half. It would be income tax-free to get the money out if we've designed it properly. And then third and lastly, I can use it like a bank. So we're finally coming back to your question that you asked. I can borrow against this policy, kind of like you can borrow against your house with a HELOC, if you're familiar with how home equity lines of credit work. I can borrow against this policy and go buy my car or go invest in some real estate or go start my business. And my policy, though, will continue to grow and compound as if I had never touched the money. Even on the capital I borrowed, it still continues to grow. So if I've got $100,000 of cash in my policy, let's say I borrow out 70 grand to go buy some inventory for my business. My business gets its stuff, it gets the inventory, and it's selling the widgets and whatever, and that's great, making money over my business. But my policy is still growing on the full $100,000 as if I hadn't touched a dime of the money. So in this way, it beats paying cash. It sure beats using somebody else's bank, because now I'm the one in control. I get to tell me when I want to repay this loan. I set the terms. I set the repayment schedule. And I get the uninterrupted compound growth, just like the banks get when they use their policies themselves.
All right, then I got a question to ask, because this is really interesting. And Mark, I just want to say thank you, and also thank Julia for setting us up. So, but now I'm thinking, okay, I borrowed 70 grand. I'm walking across the street. I'm going to go buy my inventory. Bam! I get slammed by a truck.
That truck, man, watch out.
The only reason I'm saying it is because the average age of a male in the United States that passes away is 78 years old. The average age of a first responder or veteran that passes away is 59.
Wow.
20-year difference. But the only reason I'm asking is what happens is if you're in the middle of borrowing that money and you die, but you borrowed 70 grand, what happens?
Yeah. So remember, there is a death benefit connected to this policy. It's ultimately life insurance at the end of the day. And what we've done essentially is we've cut a lot of the commissions out of it. Somewhere around 70% of the commissions have been cut out of this thing. So a lot of the expenses are gone, which is how we're able to flood this thing with so much more cash than what Dave Ramsey talks about or Susie Orman talks about. So back to your question, if I was to have, let's say, a big loan against my policy, remember, there is a death benefit. Pick your age, pick your health, but let's say that death benefit was $500,000, $500,000 death benefit. That's, let's say that's pretty typical, let's say. So we have borrowed 70 against our cash value. We walk across the street and I get hit by the bus or the truck or whatever. My family would get 500,000 minus the loan. So they'd get $430,000. And I guess you could say too, they'd also get the inventory that was waiting for them when they went to clear out my business that they could sell. Okay,
now that makes more sense to me. And now I also hear, because in my I love to learn. I'm a big learner. I also read the Bible a lot. And one of the biggest things, and people don't even realize it, one of the biggest things that Jesus talked about most of the time had to do with finances, had to do with money.
Yeah.
A lot of people don't even realize. I think it's been mentioned like something in the New Testament alone, like 300 times money or finances or something to do with trading, borrowing, debting has been talked about in the Bible, right?
That's right. Yeah. Jesus talked more about money than any other topic, I think, except the kingdom of God itself, which is saying a lot. So
All right. So
Yeah, but
now,
we have such a meager theology around money. And if you don't like the theology word, we just don't think much about money. We don't have a spirituality with our money. And either the problem I would say is we either only think about money or we never think about it. And so we need a healthy relationship with money, both individually and in our marriages and in churches, to be honest.
all right. Now, like I said, I've had Sharon on the show from Rich Dad Poor Dad, and I actually lived a life of my mother and my sister were brought up in the same house. My aunt retired a multimillionaire. My mother don't have a pot to piss in it or window to throw it out of. So I basically had a rich mom and poor mom growing up. And since I've started to study and talk to people like yourselves, I've had several billionaires come on the show. And I asked one of them, I said, well, what's the difference between a poor person and a rich person? And they said it's the words that they use. Well, poor people, they don't talk about money the same way. Like poor people will talk about rich people will talk about wealth. There's a difference between being rich and being wealthy.
Yeah.
So for the last couple of minutes, just talk about what like why certain people are successful with their money, and besides blowing it everywhere. But some people don't think about legacy. They just think like Walmart. It goes back 80 years, but their families are going to be set up for the next 100 years because they talk about generational wealth. So talk about that a little bit.
Well, that's fine. I think you've brought up a really good point about the words people use. I think that's really insightful, Richard. I'd even say there's a quote, I believe it's by Eleanor Roosevelt, who said, let's see, small people talk about people. Most of us talk about things, and the very affluent or the very wealthy talk about ideas. I like that quote a lot. So are we talking about people? Or are we talking about things like cars and boats and whatever? Or are we talking about ideas? That's one quote that comes to mind. Another is that Gloria Steinem quote that I mentioned earlier about, planning for 4 generations or planning for Saturday night. I think that is a key piece to this here. Long range thinking. I'll tell you a quick story of a great client, longtime client. He's a veteran and still works in the reserve actually, as well as has a full-time job. And he's got a bunch of kiddos, got a wife he's got to take care of, and just getting the stuff done, doing life, is the real deal. And he used his policy to get a certification to repair elevators here in Chicago. And I've always just been impressed with this guy's long range capacity. Like he's made it through some tough stuff in his life, health, everything, whatever. But he used his policy, borrowed against it, to help him start his business, repairing and servicing elevators in some of the best buildings in the country, right here in Chicago. And now he's doing great. And he's opened up multiple policies on himself, his wife, and all of his kids. And he knows that someday all these policies that he started, even on his little children, are going to be gifts to his yet to be born grandchildren. And he talks about that. He says, I want a family banking system. I want there to be a family perpetual wealth system that my grandkids come to me and they ask, hey, granddaddy, can I get a car, please? And he's the bank. Why would they use any other bank if granddaddy has all the money? And ultimately it's theirs, right? Because it's his life insurance, it's his cash. And when he passes, it goes right to the family wealth system. And so this is just a normal guy, So this is how I believe every average Joe American could participate like banks do and build real wealth rather than just seeing paper profits go up and down. Watch your Bitcoin go up and down. Watch your stock portfolio go up and down. Or even worse, just kind of living for Saturday night and financing the next car only to go back in debt when you pay that one off. I just think that there's a system and a pathway, but it starts, you're right, man, with the mindset, with the words we use and the thoughts we think.
Now I'm a big sports guy. I love sports. I love football. I'm a big football guy, and I had Lee Steinberg on, the greatest sports agent in the history of sports agents, and I had him, and because we were talking about how like Gronkowski um, has yet to spend an NFL check. Everything he's spent has only been made on his endorsements, and everything he's made over a 16-year career was never spent. It was just invested or put away. And then you get a family like the Mannings, all the way from Archie, all the way to Peyton. Now, because the reason I'm thinking about this is because I remember the draft when Ryan Leaf got taken with him, and seeing the different ways that life has went from Peyton to to Peyton to Ryan Leaf. And I think a lot of it has to do with how they were natured and how they're nurtured. And like Lee Steinberg said, there's a reason why people are successful like Tom Brady, because they worry about the little things, and they worry about, I remember who said it, but they said if you watch your pennies, your dollars will take care of themselves.
That's right.
Yeah.
Yeah, that's so true. I love that. That's a great story. This is a story, a golf story. Warren Buffett's playing with his somebody, and just a golf friend. And the golf friend says, "Hey, I'll bet you $10 for you to hit the next hole is a hole in one. It was a par three. He maybe could have done it. $10 says you get a hole in one." And Warren looks around. He says, "No bet." And the guy says, "What are you talking about, Warren? You're worth billions of dollars. You can afford a $10 wager on this hole in one." And he says, "Listen, I checked the odds, and the odds say that I'm going to lose this money. And I don't care if it's $10 or $10 billion. I'm going to check my odds before I, place that bet." And I just love that. I think that's a smart way to live. If you've got a well, Jesus says it, right? If you're faithful in the little things, you'll be, given responsibility for great things. But I think most of us put big things like our retirement, like our kids' college, like heck, even our wages from our day job, we put it on the wager. We put it on the roller coaster of Wall Street. We put it on the hole in one bet that we're going to make it with a meme stock from GameStop or AMC Theaters or, the latest Air token. And I just think that's partly why we're in such a crisis. Now, I understand prices are going nuts. Inflation is going out of control. And so there's a reason why Americans are saving only 2.3%, which is the lowest it's been since the 1990s, by the way. And well, actually, no, it was 2005. It's going back to 2005. And guess what was about to happen right after 2005 was the great crash, right?
Yeah.
So we're saving so little. We have more credit card debt than we've ever had before. And yet we're putting most of the money that we can save into things like 401ks and IRAs and things that we have no access to and have no control over. If the market tanks, guess what happens? Poof, goes our retirement. So I don't want that for whether we've got $10 or $10 billion. Know your odds and be faithful with the little things, and you'll be put in charge of great things.
And that's one thing that I really love, because I've been following you now, watching and listening to everything you talk about. And I think analytics are so important. Like for me, every day I go on my show, I go into my analytics, who's watching, where are they listening from. But I think a lot of people, they don't go into their checkbook and look at the analytics.
Mm-hmm.
They don't, because they say if where your heart is where your money is. So if you take a snapshot of the last 30 days of your checking account, it'll find out where your heart is, right?
That's true. That's really true. Yeah, that's right. And I feel like you're exactly right. And this kind of brings up a point I like to tell folks, which is everybody else has a financial plan for your money. And by everybody else, I could mean, your Morgan Stanleys or your TD Ameritrades or your, JP Morgans or whatever. I could mean that other financial planners will certainly be happy to take a fee to invest your money. And certainly that happens. In fact, the Department of Labor says that just a 1% fee over your retirement, say a 35-year retirement, is going to eat up about a third, 27%, almost a third of your life savings just to a 1% fee, Richard. So that's devastating. But the other people who have a plan for your money are Apple, Lexus, Toyota, Ford, the people who would love to take Gucci, whatever it is that is, taking money out of your pocket this month. McDonald's even, they all have a financial plan for your money. And if you're not careful and you don't have a plan for it, they're going to go again to the path of least resistance, which is the money's going to go out of your pocket and into all of the companies, corporations, and people who would love to take it from you. So it's legal theft, I would say. I'd call it that even. And it's consensual theft, which is even worse.
All right. So now talking for the last couple of minutes, because a lot of people that watch this show, we are the number, I think we're in the top 0.5% of all podcasts, especially in business.
Good for you. Congratulations.
But veterans, a lot of us come out and we become vetrepreneurs or entrepreneur veterans. So a lot of times, like I tell everybody, I do my cardio every morning and I see Amazon boxes everywhere when it's garbage day. And I'm like, so everybody's complaining about how bad the market is or how bad the world financial market is, but there's Amazon boxes everywhere littering the streets. But those same people that complain about Amazon do not sell anything on Amazon. So, talk to us about how, and I know that, whole life is awesome, but also how owning your own business or starting even a side hustle give you so many different tax breaks than just being Joe Schmo from Idaho. Even like if you start even like a little car service or even something stupid. I was doing Uber. I set it up as a business instead of just doing it for fun. And I got to deduct like my car, everything. I got to deduct my new phone, everything like that. So talk to us a little bit about, maybe starting a business to offset some of these costs that the average Joe's paying.
Yeah, you're exactly right, man. With the Amazon boxes, for sure. I'd say everyone listen carefully, because if there's going to be a recession, there's going to be a lot of people losing money. But on every side of a trade, somebody sold and somebody else bought. So if you're selling low, that means someone else bought low. And even in the Great Depression, somebody made a bunch of money buying all the stocks that other people sold on the fire sale. Okay, so that's the principle that you really want to make sure you hear, is that somebody is going to make a lot of money, whether it's Jeff Bezos or formerly Jeff Bezos. The Amazon company is going to make a ton of money in the world where we're all buying stuff, even if we're going into recession. So that's the first piece. And you're right. Look for the opportunities to start at least a side hustle, at least a side gig, or even a full-blown business, because the business owner path, as Robert Kiyosaki would say, is the way out of the wage slave spiral. And I love all the opportunities that you really have available to you in the tax code to start a business. Look, the government has decided to give us, for the most part, a free market. So they're going to incentivize those that help start and create jobs. So find ways to get employees, find ways to employ yourself, find ways to employ your kids. Lots of ways to deduct the expenses of your cell phone, of your employees, of your office space. Even if it's a home office space, you can find ways to write off your car. There's lots of things you can do. And in fact, I co-authored a book with a gentleman named Danny Stock, and it's called How to Be an Amazon Legend and Fire Your Banker. So this is right up the alley of your question here, because when you're doing e-commerce, you could do it from the comfort of your own home.
Yeah.
Heck, you could even ship it by Amazon and not even have to touch the material. But still, many people suffer and struggle in the e-commerce space because Amazon lending is one of the biggest profit centers of Amazon. What is Amazon lending? That's a bank. That's a bank. Let's call it what it is. And they charge a dramatically high interest rate. We're talking, it can be dramatically high, 30, 60, 90% APR. So the problem is still that the little guy on Amazon will get squeezed out if they're using other people's money, other banks' money. So again, if you can fire your banker and become your own source of financing, you'll win by default. quite a few of our clients, several hundred of our clients at Lake Growth Financial Services, are involved in e-commerce. We really specialize in that and think that that's a great tool for some of our clients. I don't help them, like I don't set them up on that, but I just think that they found me and found the book, I suppose. And so when they come to me, we set up a whole life policy that they can now use as a line of credit to themselves, and they can get rid of these bozos like Amazon Lending and Payable and all the other loan sharks that are out there, Cabbage, the rest of them. So now that they have this line of credit to themselves, they have a guaranteed access to money for contingency capital if they have an emergency, or if they just need money to buy their next block of toys or toilet paper or whatever they're selling on Amazon. And now they have the right and the privilege to pay it back at whatever pace they wish. So they're not rushing to sell that inventory at a discount on Amazon. They can sell it for the best price possible and pay off the loan to themselves because, again, they get to control those terms. You just become more profitable when you control the banking environment where your money lives. That's true whether you're going to do e-commerce or whether you're investing in real estate or whether you're selling lemonade. It just works if you own the banking function because, honestly, and in summary here, we're already in the banking business. We're just sitting on the wrong side of the banker's desk.
And don't you think that we're selling ourselves short due to convenience? And the only reason I bring this up, because I got a friend, he owns a restaurant, and he says, DoorDash, if you're a business owner, takes like 30%. But also if I order something from McDonald's, say a Big Mac, it may, or whatever it is, it may be $5, but after the DoorDash fees and all that, it comes to my house, it's like $9.
Mm-hmm.
And it would have cost me maybe $1 to get in my car to go pick it. But now, because I put it on my debit or my credit card, now not only am I paying the exorbitant fees for DoorDash, I'm paying credit card processing fees and interest, all because I didn't want to get my lazy ass in my car and go pick it up. Do you see this as a problem, or is this just me?
Oh no, I got the same problem, man. I especially with those big deliveries with your heavy stuff that you want delivered to you. I'm totally guilty of this. I totally overpay for that convenience, and I think the honest truth is you have to decide, what do you value more? There's only a few currencies, I should say. You got money. Everyone knows that one. That's a very obvious currency. But then you have time. That's another currency. You can only spend it. It's hard to save it. Energy. We only have so much of it. And the last currency I've been able to stumble across is attention. We pay attention, don't we? So if I can pay attention to my business and pay an extra $4 to get my hamburger delivered to me and make $40 on my business, I'll make that trade all day long. Even if it looks lazy to the outside, if I'm swapping $4 of a convenience fee for a $40 sale on my e-commerce business, let's say, then I'm comfortable with that. What I think becomes a trouble is what once is considered a convenience quickly becomes a necessity. You know what I mean? There's a famous law called Parkinson's law. A luxury once enjoyed becomes a necessity. And so our luxury of DoorDash, or my heated seats here in Chicago in the winter in my car, that quickly became a necessity for me, right? So our lifestyle creep begins to kind of gobble up our margins, takes away a lot of our capacity to save. If we're only saving 2.3% of our income as a country, but we're spending on 18 different streaming services and using DoorDash 18 times a week, maybe there's something upside down there. I don't know. What are your thoughts?
No, I totally agree. And the only reason I'm asking this, because I knew we were going to talk today. And last night we ordered Chinese food because my wife's going to go out tomorrow with her girlfriends. And so I got food for the kids. And it was like $150 for Chinese food for 5 people. I was like, oh my God.
Yeah.
But my thought is, okay, now we don't have to cook for like 4 days.
There you go.
But for me, I kind of made it make sense in my own mind. But I think because of convenience, I think a lot of people are spending money that they don't really have.
Yeah.
Just have that convenience.
Hey, I forget who said it first, and I'm going to butcher the quote. It might have been Dave Ramsey. I'll give him credit for it anyway. We buy things that we don't need with money we don't have to impress people we don't even like.
I love it. So last question is, how do we find you? How do we support your mission? I know you have an amazing presence on social media, especially LinkedIn. So how do we find you, and how do we, if we need help, how do we find you, or how do we support your mission in helping more families get the help that they need?
Man, I love it, man. I'm so optimistic about the future. There's so much opportunity when we can control the environment in which our money lives and become our own source of financing. I mean, just imagine for a second, Richard, what it would be if even just 10% of Americans were able to be their own source of financing. Like, what would happen to the student loan industry? What would happen to the credit card industry? If we never had to rely on a bank for financing for our mortgages, our cars, our credit cards, I mean, how many marriages would be saved? How many lives would be saved if just 10% of America could do this? It gets me goosebumps. So yeah, to answer your question, I'd be honored to meet with folks. We have a podcast, we have, online presence, but the best way to get in touch with me is through our website. You can reach me at kickstartwithmark.com. That's kickstartwithmark with a K.com. And we'll have a 15-minute phone strategy session to help think through, brainstorm ways to help you have more freedom and control in your life.
I love it, brother. And like I said, I'm so grateful. I'm so grateful for you, because we had to reschedule and all that good stuff. And
Thank you.
Julia has been a gem. So when
Yes, she is.
So when you see her, just tell her thank you for me. Guys, as you know, my tagline is, today I decide. Like Joel Osteen always says, you get a choice to be the victim or the victor. Well, today is your choice. You can either rent from the bank, or you can be the bank. So definitely make sure that you reach out to Mark with a 15-minute free phone call. Come on, guys. You can't get any better than that. So definitely take him up on his offer. And Mark, I just want to say thank you, brother. I'm truly humbled and grateful for you.
Thank you. And thank you for all you do and for the service you give our country and for all the people listening. Thank you.
Well, have an amazing weekend. And guys, remember, vertical momentum, the only way to go is but up. I love you guys. Have an amazing weekend. Stay safe, and I'll see you Monday. Mark, have an amazing weekend, brother.
Thank you.